Hey, what's up, YouTube? I'm back. This is Black Wall Street Trading LLC. Before we get started with the video, I need you to click that like button, hit subscribe, and come on and join the channel so you can learn more about options trading. All right, so behind me is a beautiful condor. Okay, so we're going to talk about the Iron Condor and how we can use it to make money. Also, I'm going to put some links in the description. I'm going to put TD Ameritrade, uh, Charles Schwab, Webull in the description. Those are some good brokers, solid. There are other good brokers out there, but those are the ones. Also, Robinhood. Those are the ones that I use. So the whole purpose of this video is we're going to talk about strategies on this channel that make money, that you can generate income, because the whole goal is to fire your boss. So let's get started. We're going to pull up the whiteboard today. I was going to make a beautiful PowerPoint, but I'm in graduate school still, so I've got a lot of studying to do. So we're just going to make it nice and sweet. But I'm going to explain it in detail. I'm going to tell you what you need to know. Okay. All right. So with that being said, let's go to the whiteboard. Okay. So what is an Iron Condor? An Iron Condor is an option strategy that allows you to make money. It is an option strategy that you can mitigate your losses with to very minimal. And during this video, I'm actually going to show you a couple of strategies in my account a couple of condors that I have set up. Okay, so what you need to know about the Iron Condor. The Iron Condor consists of a put spread and a call credit spread. A put credit spread and a call credit spread. If you don't know what those are, go back in some of my previous videos and take a look at that. So this is what the Iron Condor will look like when you put the trade on. Okay. So you're going to have a strike price that you purchase long, and you're going to have a strike price that you purchase short. Well, that you sold short. So you sold short, you bought long, and that created your credit. And this is on the call side. And it's going to come up and you're going to make a profit zone. It looks like a box. And if you're on Robinhood, I do not draw well, but it will look something like this. And I'll explain all this in a minute. Okay. So over here, this area right here, this is going to be your max loss areas. All right. Shaded in red. Well, scribbled in red. But the point is for you to know that these are your max losses outside of here. So similar to a butterfly, this is your profit zone right here. Okay. Now, the difference between this and a butterfly, besides the way it's set up, is that with the butterfly, typically you will get some profit, but the range, the field is a lot shorter, a lot narrower. So it's a little bit, you really have to manage that position really, really, really well. So before we talk about what you need to, how you set this up, let's talk about what you need to do prior to that. So the first thing you need to do is determine which stock you want to trade. Now, here are some suggestions. I'm not a financial advisor. This is not financial advice, but here are the stocks I like to use. QQQ, SPY, and the Russell. I think that's how you spell it. All right. I'm not sure about the letter, but when we go to my account, I'll look it up. But I'm thinking that it is IMW, but I'm not 100% sure. So I'll get the ticker symbol when I actually log into the account. The main two that I like to use are right here, QQQ and SPY. Why? Because they trade less than 30% implied volatility. Because why? You don't want to get IV crushed. Well, John, what is IV crushed? IV crushed is when you did everything that you were supposed to do, but you didn't account for a change in implied volatility that happened over a report that you weren't aware of, or quarterly reports that had not been published yet, which you should be keeping up with that, or ex-dividend date. Something made these increase the implied volatility, and it went beyond your position. Now, with that being said, right now, QQQ is at about 15-16% implied volatility. The next thing you need to consider is how far out do you want to go and what do you need to look at. Now, Theta, the Greeks that are going to be involved are going to be Theta and we can put Delta in there. We can, and I'll explain that more when we go to the actual options chain. So Theta and Delta, let's refresh. Theta represents our time decay. So as the option approaches expiration, it is losing extrinsic value, which is the price that you pay for for that particular option, or the premium price. Delta is referencing the underlying and how much of that is still available that's going to be valuable. And we want, once again, once we get to the option chain, all of this will make sense, because I know I'm a visual learner, so I like to show people things from a visual perspective, and not so much just everything's just abstract and you having to think about it. So in mine, in the option chain that you're going to look at, this right here, okay, so this is the call side, this is the put side. All right, so out here, my price is my strike price is 422. Over here, my strike price is, excuse me. Out here, my strike price is it's 430. Okay. So this is my break-even price, and this is my break-even price. If it gets beyond this, let me draw a little arrow so you know I'm talking about this notch right here. If it gets past here, 430 point anything, I'm losing money. If it drops below 422, I'm losing money. If it doesn't go beyond there, then I'm safe. But if I'm experiencing max loss outside of here. I'm experiencing max loss outside of here. But what a lot of people who teach this don't tell you is your short positions is where you, which mine here is 423 and 429. Okay, we just gonna come over here. 429 on the call side. These are my short positions, 423 and 429. Now, if you remain inside of 423, that means that the price does not go below 423, does not go above 429, you will get max profit. I'll say it again. If it doesn't go below if it doesn't fall below your short position on the put side and does not go above your short position on the call side, you will receive max profit. This is a very easy concept. Okay. So let's go look at my account because I have one that's struggling. So I'm going to stop sharing my screen for just a second. Go to my account, and then I will share my screen again. And let's see. All right. So if you will look at this position right here, 423, 429, and it's negative $90. But if we go here and we look, the total return is $490. Today's return is $120. Why is that? Because the Iron Condor consists of a put credit spread and a call credit spread. What you're looking at is the put side. The put side is doing very, very well. Why? Because it is way below what the current trading price is, and that's how a put credit spread works. Okay. The call side, because it's so close, if I look at the call side, the total return is plus 40, but I'm losing money. Because why? Because the market value is 430 and I'm at 430. That's my max. It's out, but it's not trading outside of my inside strike yet, but it could. And because it's so close, it's not showing a plus, because when the way the computer calculates these is based on what it could do if it keeps on the same pace. So I'm very, very close to my inside, to it passing outside of my inside, my short strike. Okay. It's at 427.95 and my short position is 429. So I put this trade on because I'm pretty good at technical analysis. I'm not the best in the world. I'm not an expert at it, but I know how to read those charts. And I don't believe before July I don't see anything in the technicals before July the 2nd that this price will go past 429. I do believe that I'm going to be cutting it close. And on the day of expiration, if it closes at let's say it closes at 429, on day of expiration, when as soon as the market opens and you have your sell-off, because that's when a lot of people panic sell and they sell off or take profits or whatever, what have you. The morning bell, the implied volatility is high, and I will take advantage of that implied volatility because it will be some sell-off. And if it's not in the morning, I will come in around intraday, which is after lunch, and I will start looking to close my position but I'm not going to close the whole spread. Now, if in the morning, the implied volatility is moving in my favor, meaning it's dropping down to around 426. That's going to allow me to realize more profit. Plus delta, the options will be the theta would have on the premium extrinsic value will be worth 0, and it doesn't matter what time of the day that is, because they are worthless. They're going to be, it's going to cost little or nothing. So I'll just wait. So I'm going to keep this entire condor together. I'm not going to talk about how you can trade. You can actually close one leg, one entire side of the Iron Condor, but it does have that flexibility. You can close one side if you are, let's say I was wrong on my call side, I can close my call side by itself and keep the put side open. Let's say I'm wrong on my put side, I can close my put side and keep my call side open. But you can do a single leg close on this position, but I'm not going to get into it because I don't want to confuse you. But I did want to illustrate this to you, because if you look at the overall Iron Condor, this one, which expires on the July the 22nd with which is 10, I'm losing about $80 right now based on where the price is. Now on QQQ, I have 5 Iron Condors set up. So let's look at it. So I'm long 351 strike and I'm long 359 strike. But let's pull it up. But see, look at this. Let's look at where I'm short. So let's go to the options chain and look at it. Expiring, I think it was July 2nd. All right, so let's look at the position. This is why. Look where it is. The price that is trading at right here, I'm circling around, is 354.53. Well, my short position is 359. My long position is 361. My break even is 361.12. So for me to start experiencing max loss, I would have to, for some reason, a catalyst, something, and I didn't read anything or hear about anything on Wall Street Journal, on the podcast, or Market Watch, or Yahoo Finance, or Bar Chart, or Benzinga, which are all the places that I look for news and do fundamental analysis prior to putting this on. I didn't see anything. And so this is what makes it this makes this position a very high chance of succeeding and experiencing max profit, because I just don't see in 2 days this asset rising above $359 strike, or even worse than that, rising beyond the $361 strike, 0.12, allowing me to experience max loss. I don't see it happening. And if we go to the put side on this, my inside strike, my short strike position is 351. I do not see this stock falling to $351 because it is actually trading sideways. And as you can see, the implied volatility right here is 17%, which is a little higher than what it was. But we're approaching just before lunch, so around that intraday time frame. So the implied volatility will increase a little, but not enough to where it's going to affect my position and make me worry that this is going to fall below. So this is why you see this big gap between the where it's trading at and where I actually am in the short position. This is why when we go and look at the actual at my account and we look at what how it's doing, it's already showing a profit. Now you've got some traders at this point in the game, they're profitable and they would take profit. I don't recommend you doing that because one, this is $10. It's flexing between $10 and $5. And I get it. Some people just want to take a little profit and go on with their life. The second thing is that will be a day trade because we sold to open and then you'll buy to close. That's complete and that's going a round trip. And when you make one round trip in a day, that's the day trade. And you will receive a warning. And if you do 3 of those within a 7-day trading period, your account will get shut down for 60 days. You won't be able to trade. And that would hurt me tremendously. So I stay away from day trading. The only way I'll close a position the same time in a day is because I made a mistake and I need to cut my losses because I see where it's only going to get worse. I overlook something. I'm human. I do make mistakes. Over here is a put credit spread. This put credit spread is on SPY. It's going to do well. This is the reason it's showing negative $6 is because of the extrinsic value is still high in that particular position. But by the time we get to expiration date, which is about 2 days, which is 2 days away, I'll be showing a profit here because on the put credit spread, for me not to receive max credit, it would have to fall below 424. Actually, it would have to fall below 425 for me to experience max loss. So I'm not worried about that. I mean, at all, because I'm bullish on SPY. SPY has been showing some really good indicators that it's been experiencing all-time highs, and is showing some good bullish indicators that it will go higher than what it will, just not yet. I'll have time to close the other Iron Condors out before it does. But yeah, I am concerned. I am watching it. So let's go back to the whiteboard. Okay, so now we've taken a look at that. The reason I want to give you a visual on that is to show you the importance of the short position. These positions here, because when you put a trade on, you want to receive max profit. No one wants to just get a little. You want to be able to earn your max profit. And you want to, with these, they don't cost a lot of money, but I'm going to show you about what it will cost you. Now, if you're in Robinhood, when you put these on, I know with the butterfly I showed you how you can put them on fairly cheap, but when you put these on, I personally like to put them on in a 10 lot. It's a nice round number, and you can do this every 2 days. So 10 lot, as long as it stay within those strike prices, then I will make $480. All right, so I just closed one side of one. I just closed one side of the Condors to take profit on it, and I took $70. It had different strike prices. and I was wrong. So I bit the bullet, but I'm comfortable on those. So on July the 2nd, on that position, just on that position, we're looking at $550. And then I have a put credit spread that's expiring, and that's an $80 credit that I'll see. Yep. And then I have another Iron Condor that's gonna expire 2 or 3 days after that, and the max on that is $225. And right now I'm working on my next month's paycheck, which is to be paid at the end of July. Okay. Well, August the 1st, thereabouts. And just in the Robinhood account, we will have made and cleared $855 just in Robinhood account. I'm not going to go through all 4 accounts, but if I were to do, I'm closer to $4,000 right now, and it is at the end of June. Okay, so for the next month period, last month I finished something like around $7,000, but still, this is how you make money with the Iron Condor. So let's recap real quick to make sure everyone understands how to put this trade on. And I'll show you how much it costs to put it on. Now, here's the thing. You're going to have a little bit of money in your account because they will hold. When you put 10 lots on like that, if it was $100, you can put one of these on with $100 collateral, but I put 10 on, so that's $1,000. And I have several other options. I have others out there. So I've got about $2,000 tied up, but it's a short period. It's a short period of time that you're going to tie it up. So if you only want to put one on, then you figure you need to have $100 for collateral. And the way that you're going to figure out how much collateral you're going to need is going to be the difference in the strikes. Now, if you go for every strike that you skip, that's $100. So between the strike prices, you're looking at about $200, $100 if you don't skip any. So the difference would be $100. If you go 2 strikes different, it's $200. So it's $100 for every difference. So at a minimum, it's going to be $100 when you set in this particular trade up, a minimum $100 collateral. And if you go a difference of 2 strikes, $200, 3 strikes, $300, 4 strikes, $500. I go a difference of 1 strike, meaning your short position strike price on your short position versus the strike price on your long position. And also the other thing about this is when you see where the stock is trading at, you don't have to, but it just makes it a lot nicer when you're looking at your P&L chart. If you keep it the same distance. So if I'm on the call side and I want to go 4 away from 4 above the price that it's currently trading at before I sell my first short position, then I want to count 1, 2, 3, 4, sell the 5th, and then buy the 6th. And then on the put side, I want to do the same thing. I want to go 1, 2, 3, 4, sell the 5th, and then go right below it and buy the sixth. That way it's nice and even, and you get that box, and you got equal max loss on both sides. And the main things you want to look at is where you are. So drawing the box back up here, this is our box. On the corners of the box is the break-even prices. Outside of the box is your max losses. Inside the box is profit. And how do we receive max profit? By staying between both short positions. I'm going to put SP for short position. Not writing all that out. This is where you get the good stuff. Right here. By remaining between these short positions. So when you're looking to put the trade on, you want to know what the technicals look like for the short position. Does that not make sense? Don't study the technicals for the long position. Study the technicals for the short position. All right, so before we end the video, let's talk about what can go wrong, because it can. All right. Let's talk about what can go wrong. And instead of using green, I'm going to use red. I'm going to use both. I'll use both. So I really want you to understand this. Okay, so if you have to go back and watch the video, go back and watch the video, but really pay attention to what I'm saying. All right, so there's no confusion. I'm going to actually put sides on this. This is your put side, and this is your call side. All right, and this is going to be the direction. This is going up, and this is going down. Put, call. All right. So right here is your short position on the call side. And let's say it's on the day of expiration, you're feeling good. You're like, this is wonderful. This is great. And then right at closing, this is why I urge you, if you're close it out yourself. Don't rely on your broker to close it out. If you're close. If you are really, really good, within close to, when I say really, really good, I mean you're not outside your long position. So LP is long position, SP is short position. Okay, you're not outside this long position right here. Okay, you're not even close to it. But let's just say 5 minutes before you left and you took a nap, you took a nap, and 5 minutes before the bell sounds, your price goes outside this wall, and then this is the call side. So if you're on the call side, then that means this can get exercised. And what does exercise mean? Exercise means that somebody wants to buy some shares and you have to sell them those shares. So but the only problem is you don't have those shares. And if you're broker, if you're on Robinhood and all works out fine and they get to you, they will simply assign the shares because it's a call side. They assign the shares and then all is well. It will wash itself out and everything will be good. But what if they don't get to you? Don't worry. It's going to be some moving going around in your account, but you don't have to worry too much. But I'm just telling you, this can happen and it can go wrong, because if they don't get to you and your long position, which is supposed to be your safety, the market closes, this is worth zero. So what happens? Well, the broker will pick up the shares and then you'll have to sell them in the open market. They'll close out your other side over here and it's not going to be that bad. But what if it's on the other side, the put side, and you get assigned those shares and your protection expires worthless? See, when you get assigned those shares, well, there's supposed to be a dollar amount of collateral for you to cover those shares, because on assignment, you are agreeing on the put, you are agreeing to buy 100 shares of the underlying if it falls below. So let's say at the very last minute, your short leg, your short position, the price dropped below your short position. It dropped below, excuse me. It dropped, it fell, it should be going this way. It fell below your short position. Well, if that happens, you're going to get assigned shares that you don't have money to buy. And your long position, which is your protection, is worthless. It's not worth anything. So now you are way past the margin call, because these shares, you saw the strike prices are 300. Well, for SPY, it's more than that. SPY, it is $424. And don't forget, we have to multiply this by 100 because it's 100 shares. So you're looking at $42,400. And you don't have any, your long position nothing covers you. Okay. So even if you are able to be covered on the call side for this position, exercise the long position on the call side, you have nothing there, because the long positions are no longer available after the market closes, because they lose the most extrinsic value. They're zero. They're worthless. They're completely worthless. Those are the ones that are furthest away from the money. The ones that are closer to the money have value left in them. The ones not. And all of this happened with 5 minutes left to go. See, remember, when a put can be assigned and a call can be exercised up until the end of the day. So with 5 minutes left, this happened. You're not watching. It happens. There was a trader that lost $30,000 just like this. He had no protection, and I mean, it was just bad. It was just really bad. So that's one thing that's what you have to be mindful of. That's one of the reasons you need to close your own option spreads out. Now, typically you can let an Iron Condor go to expiration, and all will be fine. And you'll get your max credit, you'll get everything back, you'll get your collateral back, everything will be beautiful. So this is why I stress and urge you, learn technical analysis, learn how to read those charts. There's videos on YouTube about it. You can read it, Investopedia, you can read about them and get some examples. I'll start making videos and trying to teach you how to read the technical analysis, but this is why you need to be able to read those technical analysis. Now, aside from worst case scenario, this is the worst case scenario. Like, that's the worst case scenario. If you close them, so how do you avoid it? You can close it the day of expiration. Don't be greedy. Get what you're gonna get. It's a day of expiration. I mean, these options, they have multiple two-day trades you can put on. Don't be greedy. Get you 200, 300, 400 max. Get the max. You have the max at the end. Close it. It might cost you $20 to close all 10 positions. Close it, collect you about $350, $400. Go put you another trade on and go get you a Starbucks or something. But don't be greedy trying to, I just want to see everything. No, close it yourself. Or if you're really good within the month, everything is really, really good. The market's about to close in 5 minutes. Check it one more time before you lay down or leave the house, and you like what you see. You're way under this within your price, within the price action. Nothing to fear, nothing to worry about. It's not going to change that fast in 5 minutes. You're good. Okay, let it expire worthless. Let it expire worthless, and then when you log on to your account the next day, after everything is settled, you're going to see a nice little increase in your buying power, and you'll be able to withdraw that money and start making more money and put more of these on. Now, if you have any questions, leave them in the comments. That's the end of the video. I hope you understood it. I hope you try it if you're ready to try it. If not, you still have questions, just hit me up. A couple of people have hit me up in the past and had questions about the video, so that's good. Now, this is a really nice option strategy to make money on, consistent money. You just have to keep up. You have to do your fundamentals. Don't let other people tell you what you need to do. You need to do your own homework. Put the time in. It takes about an hour, hour and a half. Once you have the right tools and you can see what the market is doing. Once you learn how to do technicals, you'll be able to see what bullish indicators look like, what bearish indicators look like. You'll be able to see which stock, if they check your implied volatility, do all those things, follow your trade plan. Don't invest more than you can stand to lose. I don't typically, a lot of times I won't go more than 25% of the capital that I have to invest with. All right. So that's the end of the video. Click like, subscribe, and share. And I'm out of here. On track, now we gon' way up.